Hey everyone, it's Matthew Haraburda here at Bernardo Wealth Planning, Chief Investment Officer. Just wanted to reach out to everyone as we're now starting the fall to kind of give our recap of Q3 and our outlook for the remainder of this year. All right, so let's dive in. So for this session, we're going to look through some slides that our partners at JP Morgan Asset Management have put together. I think it does a really great job of highlighting what has happened so far this year and even further, and then it helps kind of put context around our outlook for the remainder of this year. So let's dive in. So I think one of the biggest changes that we've really seen in the market is that the Federal Reserve has really kind of shifted from thinking primarily about inflation, which is really what they've been primarily trying to fight for the last 5 years or since COVID, to more of the labor market. So this slide, I think, does a really great job of showing all the components of inflation. And you can see there, as of the end of July, inflation, while not at the 2% long-term target that the Fed has somewhat suspended for the time being, you can see by and large inflation has come under control. Over the last several months, you have started to see that trend up. But again, when we look at back where inflation was right after COVID, it peaked at about 9%, 9.1%. And right now, when you look at everything, it's closer to 2.7 or 2.8%. So we believe that this is one of the main things that the Fed is looking at when they decide, do we want to prioritize or do we want our policy to balance more to kind of fight or help the labor market, or do we want to kind of have that policy directed exactly towards inflation? So again, I think this slide does a really great job of kind of showing what all those components are and where we are today. So next, on the labor side of things. So obviously the Fed has a dual mandate of inflation and unemployment. And you can really see on this left graph over here, the non-farm payroll gains, how there have been fewer and fewer jobs added to the economy over the last several quarters. So we believe that the Fed is looking at this data and is saying, hey, I think that we do need to start looking at how we can start to help and really be constructive towards the labor market. As anecdotes, we've been really trying to read as many of the quarterly reports as we can and a lot of the interviews with a lot of the Fortune 500 companies. And it does seem like there is a lot of CEOs out there talking about not hiring at the pace that they have over the last several years. And you've absolutely started to see some jobs being cut at some of these largest companies. So we think that the Fed is thinking through how is that going to impact the underlying economy and markets in general. So next, we'll look at tariffs. So obviously this was one of the main culprits of the market disruption that we've seen so far this year. And the reason that I included this slide is that I think that when you first see that headline of the tariff rates that the administration is talking about, they're obviously incredibly high numbers. That's not going to flow through to the economy the day that they actually enact that. Typically, you'll see that there is a pretty big difference between the statutory tariff rate and the effective tariff rate that we're actually seeing today. Now, obviously, we do think that that effective tariff rate is going to continue to kind of creep up over time the longer that the tariffs remain in place. But I think this slide does show that it's not like we get that immediate jump right up to 30% overnight. And a lot of the companies that we've been following really have said they've either chosen to not increase the price to their consumers and just eat margin on their side. But we do think that over time, you will start to see some of these companies having to adjust either their where they're sourcing their products from, where they're pricing the product, because at one point something has to give one or the other. But again, we think that this slide does a really great job of showing exactly, hey, there's the sticker headline number, and then there's the effective rate that we've actually seen so far. So where does that leave us with regard to our thoughts on the overall market? So it's no surprise over the last several years, the stock market has done incredibly well, specifically within the US. So you can see as of the end of August, we're standing at just over 22 times forward earnings. I think this chart does a good job of showing that historically about 17 times is where the average stock market has been on a forward guidance. And then we're about 1.5 times standard deviations over that with where we're standing today. So as we have just thought about portfolio construction and the things that we want to invest in the market, we have become a little bit more defensive, primarily because we think the market is priced at a neutral level where if we get any sort of growth scare or if we see inflation flare up at all, that you'll likely see volatility come back to the markets, and you'll likely just see more volatility with a lot of these broad indices that we're investing in. So it's not to say that, hey, we're running away from the growth areas of the market. We just want to be a little bit more nuanced with kind of where that marginal dollar is going and we do have a preference for value over growth in the current market. And I thought that this slide really puts together exactly why we think that over the longer term, the returns that we've seen over the last kind of 2, 5, even 10 years are likely unsustainable going forward. I know there's a lot of excitement surrounding AI and kind of all the productivity gains and the GDP gains that we could see from that. And we'll go through that in this deck as well. But this slide really does talk about, if you look at the forward PE that we have, again, that's at about 22 or 23 today, and then the subsequent 1 year and 5 year returns, what this slide is really showing is that the higher price or the higher multiple that you pay today, the lower the future value expected returns of that product that you have. And obviously we're talking about the S&P 500 here. So you can see there's a pretty strong correlation that the higher price that you pay for something, the lower the future returns are. So just think that this is really important to keep in mind as we think about just kind of long-term capital market assumptions. A lot has been written here. A lot has been written in general over the last couple of years about the Magnificent Seven. And I think that this slide really does a great job of kind of highlighting how much we really have seen that part of the market grow and how much concentration that really is within the overall index. Again, that's the slide here on the left. But the thing that's more important in my mind is actually looking at how much the earnings have really grown there as well. So there's good reason these companies are trading up as much as they are. Obviously, there is a lot of hope within the market that a lot of these stocks will continue to be able to deliver strong earnings growth. That's kind of what has given them the multiples that they're trading at today. But think that this really does show exactly the reason why these stocks are talked about so much day in and day out. When we think about the Fed cutting rates, typically that would help small and medium-sized businesses at the margin a little bit more than large companies. The primary reason for that is that large companies typically have fixed rate term debt. So when the Fed looks to cut interest rates, yes, financing does become does become cheaper for most companies, but a lot of the large companies, they don't have a lot of their liabilities tied to front-end interest rates like small and medium-sized businesses do. So I wanted to include this slide because we have become a little bit more constructive on small and medium-sized businesses, specifically if front-end interest rates are going to continue to come down as the Fed just cut rates for the first time this year during September. But one thing that we really do want to point out here on the right-hand slide, you can see the forward PE versus the 20-year average. Again, there is some discount for buying medium and small cap stocks, but we don't see it really standing out as much as we would like. So we're okay right now continuing to have our preference for the large cap companies. We view them as slightly more defensive in this uncertain market. Everyone's favorite topic, AI or artificial intelligence. Again, we're not going to be speculating about who the biggest winners are going to be in the space. I think that it's really difficult. There's a lot of speculation out there about, can we pick the winner in AI? Is it a winner take all type market? We continue to believe that the best way of getting an allocation to AI in general is by a diversified portfolio. And by owning a lot of the stocks that we do within our ETFs, we are getting indirect exposure to a lot of these trends. One of the stats that has really, it's one of the things that I think is most interesting about this AI craze is that when you think about what's driving the US economy, typically you think of the American consumer. And while the US consumer is absolutely still driving the economy, CapEx or spending on data centers and kind of just the build outs of all the picks and shovels of what AI is kind of building out within the industrial space, that accounts for just as much GDP growth as the US consumer right now. And one thing that really shows in this graph here is obviously you can see almost the exponential growth in CapEx from these major AI hyperscalers. But the thing that is amazing to me is that you can see how much of their actual cash flow, their operating cash flow, they're spending to kind of build out their AI capabilities. That's been what's really been helping driving the US economy over the last several quarters or years. So one thing that we're really following is if we see any slowdown regarding the expectation of how much money they're going to continue to plow into that sector, how is that really going to impact the overall growth? Because when we think about how they're funding a lot of this, a lot of these companies are flush with cash. They do have very, very high free cash flow and operating cash flow margins. However, at some point, they need to start seeing a real return on these investments that they're making in order for them to keep making them and have all of this build out make sense. So this slide, I think, is fascinating for a lot of reasons, but it not only shows the scale of kind of all these data centers and the industrial sites that are being built out, but it really also highlights that these companies are really making a very large bet building out their AI capabilities. And as a result, it's helping really drive a lot of the U.S. economy. This is another slide similar to what we were talking about earlier with our expectations of value being a little bit more defensive right now than growth. You can just see that the long-term average, that growth does look a little bit more, or that value looks a little bit more attractive right now in the market than growth, just given the overall valuations. This slide, I think, really highlights that the price that you pay for a bond today really does forecast what the total return for that bond is going to be. If you look here, and we'll just kind of go right from the colors. If you look here from in the 1970s, obviously interest rates were anywhere from about 4 to 8%. And then this was historically an era where we really saw very high inflation in the 70s and 80s. And that's why you can see a lot of these dots up here that are kind of in the navy blue. That is when interest rates were going up higher, and the subsequent returns from the 1980s almost all the way through the 2010s, you can see were decreasing because U.S. Treasury yields were decreasing along the way. So the big thing that's really changed since then, so since the 2010s, you can see these years there were negative returns within the fixed income market. Obviously, that's really been what's happened post-COVID, since we've seen interest rates go from about 1 or 2% up to 5.5%, now closer to about 4.25%. So where we live today is a pretty good estimation that we do think that the bonds that we're purchasing today should have a return profile of approximately 4.5 to 5%. Obviously, we don't know where interest rates are going to go here in the next 3, 6, 9, 12 months, but we do think that they'll be somewhat range bound. So that we think that this is a pretty good estimation of what you can expect from a fixed income portfolio. Obviously, if we see interest rates come down more and there's bond price appreciation, they'll be higher. But if we see interest rates go up, obviously that number will come a little bit lower. But really think that this helps frame kind of what we can expect with regard to our fixed income portfolios. And lastly, I think that this is something that we wanted to highlight whenever we talk about alternatives in the market. Do we want to buy alternatives that are liquid? Do we want to buy alternatives that are not liquid? What are the pros? What are the cons? And so one of the reasons why we talk about alternatives so much at Bernardo is that we believe that they really can be a diversifier within a portfolio, and that's how we want them to act. What this slide shows is that if we look at U.S. public market REITs, you can see they actually have a pretty large correlation, a pretty high correlation to the S&P 500. So that means effectively that the correlation is about 0.8%. So for every percentage point that the U.S. stock market, the S&P 500 trades up, 80% of that we can expect to see be correlated within the public REIT market. Whereas if we look at when there is direct real estate correlation, it's about negative 0.8. So the reason that we really want to highlight and talk about this is that we believe that our private investments or our alternative investments that we make really should be in more private wrappers or really not in liquid products, because we think that this is the way that we will truly get diversification rather than just having another asset that's highly correlated to the S&P 500. So I hope this slide makes sense and kind of highlights why we do have a preference for keeping our privates private, so to speak. That concludes the Q3 wrap up and Q4 outlook for this year. If you have any questions, please feel free to reach out to myself or your financial advisor to discuss more. Thanks so much. Bye.